Most people think investing is one size fits all. Pick a fund, set it and forget it, done. But here's what nobody tells you. The strategy that builds your first $10,000 is not the same strategy that builds your first $100,000. I started investing at 35, and 8 years later, I became financially free. Now I'm investing publicly from $10 to $1 million. And right now I'm at 6,000 in just 6 months. Today, I'm covering the 4 strategies I'm focusing on right now at this stage of the journey. As my portfolio grows, I'll be adding more, and I'll cover those when we hit the milestones that make them relevant. So, if you're a beginner investor, this video is for you. Investing in the stock market offers the potential for significant long-term growth, with historical average annual returns of 11%. While these returns fluctuate year to year, maintaining a long-term perspective can lead to substantial wealth accumulation over time. But here's the thing, returns don't just happen. They happen because investors show up consistently with the right strategy at the right stage of their journey. That's exactly what I'm discussing today. Strategy number 1. Balanced funds, also known as hybrid funds, are a type of mutual fund or exchange traded fund, which invests in a mix of asset classes, typically a combination of stocks and bonds. The goal of balanced funds is to provide investors with a diversified portfolio that offers both growth potential from stocks and income and stability from bonds. Here's why you should care about this one. When I first started investing, the hardest part wasn't the fear of losing money. It was the overwhelming number of choices. There are thousands of funds, hundreds of strategies, and everyone online has a different opinion. A balanced fund solves that problem because instead of trying to figure out how much to put in stocks versus bonds, the fund does the work for you. You're not staring at a screen trying to decide between 47 different options. You pick one fund and you're instantly diversified across both stocks and bonds. Think of it like this. If the stock market drops 20%, bonds don't drop with it at the same rate. Your portfolio doesn't take the full hit. Strategy number 2 is buy and hold. This is less of a strategy and more of a mindset shift that will change how you see the market forever. Let me tell you why this one's personal to me. I spent over 16 years in the hospitality industry. I watched 2 recessions tear through the industry. I watched hotels close after COVID hit, and I watched investors who panicked and pulled their money out of the market, lock in losses they never recovered from. The investors who held, who stayed the course even when it was terrifying, came out ahead every single time. Buy and hold is exactly like it sounds. You buy quality investments and you hold them for the long term. Long-term investors lean on this because the market's overall trajectory has historically trended up, even though it's bumpy along the way. So instead of reacting to every short-term dip, you stay committed, ride out the downturns, and keep your eyes on the long-term goal. In my $10 to $1 million investing series, every share I've bought in this series, I still own. I haven't traded a single one yet. So if you're watching this series, you're literally watching buy and hold happen in real time, month after month, right here on this channel. Strategy number 3 is DRIP. DRIP is widely used by investors who seek to maximize the power of compounding returns over time. When an investment pays you a dividend instead of taking that cash out, you reinvest it to buy more shares of the same investment. Over years, it can potentially accelerate how fast your portfolio grows. Here's why you should care. Let's say you own shares of a fund that pays you a $50 dividend. Without DRIP, that $50 just sits in your account as cash, doing nothing. With DRIP, that $50 automatically buys more shares of that same fund. Those shares then generate their own dividends, which buys more shares, which generates more dividends. That's compounding, and DRIP puts it completely on autopilot. For my private investments, I keep automatic reinvestments turned on. So whenever a dividend gets paid out, it buys more shares for me. Here's the step most people miss. In your brokerage account, you have to look for a dividend reinvestment option. Then check the box. Without it, dividends just sit in your account as cash instead of automatically buying more shares. Compounding is already powerful. DRIP puts it on autopilot. Strategy number 4 dollar cost averaging. And this one is a favorite for beginners because it takes the guesswork completely off the table. You invest a fixed amount at regular intervals, weekly, bi-weekly, or monthly, no matter what the market is doing that day. You're not watching the news. You're not trying to guess whether it's a good time. You just invest. When the price is low, your fixed dollars buy more shares. When it's high, that same amount buys fewer. Over time, it smooths out the average cost per share and keeps you investing through the ups and downs instead of sitting on the sidelines waiting for a perfect moment that never really comes. Now, full transparency. Technically, dollar cost averaging says a fixed amount. A fixed amount is not what I'm doing every month. For the sake of this public series, I'm putting money into my brokerage account every single month, but my account isn't always the same. Some months it's more, some months it's less, depending on what I earn each month in this series. What I personally do is really consistent investing, the close cousin of dollar cost averaging. The part that really matters most is that I show up every month no matter what the market's doing, because consistency is what builds wealth. So today I'm continuing to build wealth and investing $182.00. I earned this month's money from 4 hours of DoorDash, dividend investments, interest income, and cash rewards. I'm investing the entire amount into an index fund, VTI, Vanguard Total Stock Market Index Fund ETF. If you're interested in learning more about index funds, my course Stop Guessing and Start Investing with Index Funds is linked below. So that's 4 strategies you can use as a beginner. Balanced funds, buy and hold, drip, and dollar cost averaging. As my portfolio grows, I'll be adding more, and I'll cover each one as we hit the milestones that make them relevant. Subscribe so you don't miss it. And for everyone that's followed me since the beginning, I appreciate you.